Hi, Charles Sizemore here. So this week I'm going to talk about one of my really all-time favorite dividend stocks. It's the REIT STAG Industrial. But before I get into the specifics on that, let's talk about what really makes a good dividend stock. Over the last couple videos here, I've talked about things I like in a dividend stock. I like a reasonably high yield. I don't shoot for the highest yield available, of course, but I like a competitive yield. I like consistent dividend growth, but kind of beyond those, kind of obvious, easy to measure things, I like bulletproof businesses. I like businesses that can survive the apocalypse, because if you own a stock long enough, eventually you're going to face the apocalypse, whether it's a pandemic like last year, whether it's a meltdown like 2008, whether it's .com crash, whether it's commodity bust, whether it's war, famine, whatever. If you own a stock long enough, eventually you're going to suffer pretty well any event that could happen. So you really want to have stocks that are as close to really truly bulletproof as possible. And more than that, particularly these days, you want stocks that are future-proof. Now, you could have a stock that's had a great 100-year track record, fantastic business, but then along comes a new technology and it blows it out of the water. And, if you're you can buy a great buggy whip maker that paid a great dividend, and then as soon as the automobile comes around and no one's buying horse buggies, well, it's all for naught. So you do want stocks that are as future-proof as you can imagine them being, right? So that brings us back to STAG. STAG has a really kind of macho, kind of, cool sounding name, STAG, like a buck, right? But it's actually about the most boring stock you could imagine. It's a REIT, and they own nothing but a large portfolio of just sort of gritty industrial stuff, the kind of things you really don't want in your backyard. They own things like distribution centers, warehouses, kind of light industrial buildings. When you drive by the airport in any city in America, and you see those businesses kind of close to the airport that are just, truck centers where, big trucks come in, get loaded up and go. STAG owns that kind of stuff. And the reason I like that, it's multifold here. For one, owning real estate can be just prohibitively expensive. If you own a nice hotel property or a nice office building, you are constantly having to throw money at appearances. Your tenants care, your shoppers care, your clients care. They want the building to look nice. If it doesn't look nice, it's a big problem. When you talk about kind of gritty industrial properties, no one cares. They're really low maintenance buildings. If there's a few scuff marks on it, who cares? It's for loading and unloading trucks, for crying out loud. You're not wining and dining people there. So because these properties don't have nearly as much in the way of capital expenditures, they tend to be a lot cheaper to own and more profitable. But beyond that, they also tend to be, I don't want to say recession proof, because if you do have a deep enough recession, obviously economic activity slacks off a bit and you do have weakness, but they're pretty recession resistant. Even if the economy does slow down a bit, you have fewer trucks going in and out, you have less economic activity, less warehousing, kind of less light industrial activity going on, sure, but it's generally going to be enough to keep the rent checks coming, right? And certainly over the last several years of upheaval, particularly last year, STAG really did a fine job of that. I mentioned being future-proof, sort of being Amazon-proof. STAG is absolutely Amazon-proof because, in fact, Amazon is their single biggest tenant. Now, Amazon does not make up a huge piece of the portfolio. It's about 4%, but still, Amazon is their biggest single tenant. So you want to, be Amazon-proof. You want to get out of the way of the Amazon bulldozer that just wrecks everything it touches. The best way to do that is to be on Amazon's team. And that's exactly what STAG does. STAG provides those basic warehousing and distribution services for Amazon and companies like Amazon. Overall, about 40% of its properties are directly tied to e-commerce, and that's only going to grow over time for a couple of reasons. One, e-commerce is exploding, but beyond that, even traditional brick and mortar companies are utilizing more e-commerce. So a property right now that may not technically be used for e-commerce purposes probably will be in a few years. So these guys are very, very, very well positioned. The stock pays a very solid 4% dividend. And where it gets kind of fun is STAG is actually a monthly dividend payer. That's really rare. Nearly all dividend paying stocks pay quarterly. That's the reporting cycle. Companies announce earnings every quarter, so they just sort of declare and pay their dividends on a quarterly calendar, at least in the United States. Overseas, particularly in Europe, it tends to be semi-annual. But the typical American dividend calendar is 4 per year, quarterly. STAG bucks that trend. STAG pays monthly, which is actually pretty nice. I would never buy a stock or recommend a stock purely because of the dividend calendar. That's ridiculous. You should never buy a stock because of that. But it is sort of a nice added bonus. It is nice that your expenses are monthly, everything from your cell phone bill to your mortgage payment to your, if you have student loans or you're paying for your children's student loans, whatever. The monthly side, the billing cycle for most of our expenses in life tends to be monthly. And so it is nice to have a few monthly dividend payers in your dividend portfolio to kind of be there when you need the cash. It makes your cash flows less lumpy. So just consider that an extra bonus. Now, of course, this is money in markets. We do like to use our green zone rating system whenever we analyze a stock. That's sort of the lens that the primary lens through which we view companies. Yield can look great on paper. A company can look great in the headlines, but you really need to drill down into the numbers to kind of determine its real quality. And so I am happy to say that STAG rates well on our green zone rating model. It rates a 65, which is firmly in bullish territory. Based on our back testing, stocks that rate in bullish territory of a score of 60 or higher do tend to outperform the market by 2 times over the following 12 months. That's what the historical data says. Obviously, past performance is no guarantee of future results, but I like our chances here. Now, digging down into it, this is going to be surprising after everything I've told you about this being sort of a gritty, boring, not particularly sexy company. Its highest rating is actually in growth, and it rounds up to 100. It's 99 point, yada, yada, yada. It rounds up to 100, meaning that they're less than 0.5% of all companies in our universe rate higher based on growth. If you look at the specifics there, it's really not hard to see why. When this company went public about a decade ago, it had 14.2 million square feet under management. Today, it has 98 million square feet and growing. The company owns 492 properties spread across 39 states. And of course, it's adding to that every single year. So for a very boring, gritty, under the radar stock, again, the sort of properties you would never really want to have in your backyard, this little company is a growth dynamo. It's, again, scores of 100. That's not bad. What might be equally strange is that for a company that rates that high based on growth, it also rates exceptionally well on volatility. It rates an 88. Now, of course, a high score on volatility means that the stock is non-volatile. That's not surprising at all when you have listened to everything I've just said about the business model being very stable, predictable, recession-proof. It's not surprising that the stock has low volatility, but it is sort of unusual to see a high growth dynamo also have exceptionally low volatility like this. So this may be a testament to how sad my life is, but that's exciting to me. I get excited about things like this. I should probably get out more. Anyway, moving on, value, it rates sort of middle of the pack on value. Now, as I've explained in previous videos, our value score sort of gets negatively skewed for REITs, and that really comes down to REIT accounting. REIT earnings tend to be depressed. Depressed is probably the wrong word, but standard GAAP accounting does not really do justice to REIT earnings. They tend to be skewed by high depreciation expenses. And because value has to be relative to something, you're comparing a price to what? To earnings, to sales, to whatnot. REITs tend to get really punished there because their earnings tend to be depressed. And it is what it is. So when you see that value score of 50, that looks middle of the pack, just understand the real value score should be a little bit higher than that if you allow for sort of the negative bias against REITs that our model does have. I would say the same for quality. The stock rates a 48 on quality, putting it right in the middle of the pack. I would say that is understated. REITs do tend to have high levels of debt, which penalizes them on this score. They also tend to have low reported profitability, which also really penalizes them. So the fact that it scores even middle of the pack, considering that it's handicapped there by GAAP accounting, that's telling. It shows that this is a high quality business whose quality is not completely reflected in its score. Now on size, it rates at 31. This is a mid-cap REIT. That's good. Normally we'd like to see a little bit of a higher score there, but that's okay. This is still a mid-cap if you are of the belief, as I am, that as large cap stocks really do look fully valued right now, investors are looking for that next rung down the market cap ladder. That brings us to mid caps like STAG Industrial. I think I will just say I'm very comfortable with the size of this stock, and I think I expect that to be actually a positive for it over the next year. And then finally, this was a little surprising to me. The stock rate's low on momentum at 25. Now when you see a score like that, you expect to see the stock in a downtrend. And I really, I'm not the technician that Adam is. Adam is our technicals guy. This is what he lives and breathes. I'm more of a fundamentals guy, but all the same, I will not buy a stock if it's a falling knife. If a stock is in a steep downtrend, I'm not going to be the hero that tries to call that bottom. That very, very, very rarely works out. And Adam, our technician, would agree on that. He is a very big believer in buying high, selling higher, as opposed to trying to be the hero that buys low and picks that bottom. The tenet of momentum investing is you buy something that's ripping higher, you hitch on and you go up with it. So STAG, I wanted to do a little bit, deeper dig when I saw that it rated only 25. A couple of things I'll point out. The stock actually is in a really strong multi-year uptrend that got upset, of course, last year, but the stock recovered nicely. The main loss of points here, where the company loses points on the momentum scale, on the momentum rating, is that its up volume doesn't rate well. I'm really not speaking well today. Its up volume relative to down volume, it scores low based on that, and that does pull down the overall average. That's not something I like. I would prefer that it rate higher based on that submetric. But considering that the stock is in a good solid uptrend, it has been trending higher for years. Everything else looks, very kosher here. I'm not going to sweat that low momentum score. And just understanding that, I would like to see it be higher, but that's not a deal breaker. So overall, STAG is, a very solid bullish stock for us. It rates at 65. Again, what makes this stock appealing is I don't know what happens in the economy next. No one really does. People will throw out their forecast, but nobody really knows. I think the worst is behind us on the whole pandemic business. It's very obvious that the economy is opening. I think we are looking at a couple of years of very solid growth. I think that growth is going to shift away from tech to some extent, more to good old-fashioned brick and mortar. I do think at the same time, though, the leaders like Amazon will continue to grow and add capacity. That's just a foregone conclusion. I feel like STAG is right in the middle of all these trends and is in a very good position to benefit from really all of them. So this is a stock I'd be very, very content to buy, just kind of drop in that proverbial drawer and not look at for a couple of years. Just collect that dividend, that 4% dividend that has been rising consistently over the last 10 years. That's a nice place to be for the foreseeable future here. So that is the dividend stock of the week. We'll catch you next week.